Welcome to the Gray Report. Exciting news in the apartment industry. Gray Capital, we have a new project that we're working on. We'll be under contract shortly. So if you are a accredited investor, you want to hop on over to the Gray Capital portal at graycapitalllc.com to request your access so you can be one of the first to review this new exciting project. I can't give you all the details other than it is in Indianapolis. It's an incredibly newer asset with an unrivaled amenity set and an incredible location. I drive by it a handful of times a week. We know it really well. We know all the comps. We are just gearing up and getting ready for this opportunity. We couldn't be more thrilled about it. If you're a listener of the Gray Report, you know how much we love our home market of Indianapolis. This is one of the first deals we've been able to buy in Indy in the last couple of years. Buying at a huge discount to the comps, 25.5%. I'm getting too into the deal. Let's get into the Gray Report. From RealPage, apartment occupancy ticks up for the first time since February 2022. Welcome news to apartment investors and developers as we are seeing really surprisingly strong positive absorption levels in a period where we're seeing supply hit a 40-plus year high. And then from Yardi Matrix, looking at their national multifamily rent report for April 2024, then onto Reuters, where we're going to be examining the state of the consumer in the United States, affecting how that may influence rent growth and occupancy and demand and just apartment fundamentals, but also how a weaker labor market it may influence the Federal Reserve to lower interest rates at some point, because we know how important wages are to the economy and inflation. And on that note, from the Motley Fool, consumer credit oozes up 0.4%. And from the Federal Reserve Bank of San Francisco, pandemic savings are gone. Really, of course. It's been 4 years. The money's gone. So what's next for the U.S. consumers? We're going to be digging into all of this and a lot more. So if you're an active multifamily investor, passive, you're in the industry, strap in, you're in the right spot. We're breaking into all these research reports more, throwing out some original opinions. Let's get into it. Welcome back to the report. Joined again by Director of Communications and Marketing, Dr. Matt Bosnagel,
Hello.
Joining us in our beautiful Indianapolis, Indiana studios on a lovely spring sunny day. Matt, we're looking at the consumer today, but we're also looking at some of these green shoots of spring for the apartment industry.
Yeah.
We're starting to get into leasing season. And we're starting to see some positive signs, which we would expect this time of year, right? So, there's some seasonality that we need to take into account. Like we should see strong growth historically. Yep. We're seeing growth, which last year we didn't see the growth. So at least we're seeing some growth. Maybe it's not as much as it was in recent years. But before we get into this RealPage report, Matt, anything that's missing from this week's report, anything else that you're seeing going on in the apartment market do you think is worth noting for listeners and viewers at home?
I think that it is worth noting, what we covered last week was the apartment list report, which showed a little bit lower rent growth than was expecting.
Yeah.
And it also showed occupancy was a little bit weaker than what we're going to describe in this week. They typically have a maybe worse performing, I would say, rent growth report, or they
apartment list.
They typically report lower numbers than other sources. However, there's still information in that apartment list report that would agree with the current more positive takes. I think that in general, it does seem like a wave of negativity has kind of reached its bottom point, and things are starting to pull up. But they were down in the doldrums all of 2023, and we're really trying to pull up. And so it is going to be a little bit dampened just because it's so much effort and so much supply is still coming online.
So, go back and listen to last week's episode and kind of get some context from Apartment List. And, that's why we like doing this show, Matt. And one of the reasons why we started it is talking about these different reports, sometimes getting into their methodology. And we've brought on, the directors of research from, most of these publications, whether it's Paul Fiorilla from Yardi, and folks from Apartment List, folks from Berkadia, kind of across the board, kind of getting their take on how they're putting these numbers together. And it is interesting because they're not using the same kind of algorithm or same store data. A lot of times it's their own proprietary data. So we're looking at different store information, maybe from different interpretations, and then we kind of all put it together. And then maybe after, a couple periods of reporting and looking at different sources, you can have a really good sense of where the market is. And that's kind of what we like to do here.
And I will, I'll admit, last week I said it on the report that I made a bad prediction. I was wrong. I predicted that rent growth would go up in the Apartment List report, and rent growth did not go up. However, if you look in other sources, it's not all of the same.
What about the aggregate? Maybe next week we can look at the Gray Capital aggregate rent growth report, and so let's see maybe what your prediction is if we look on the aggregate, because that's really what you were kind of pegging yourself against.
And some of this stuff, some of the information that we have on demand and occupancy may not trigger rent growth immediately, but certainly are the signs of strength throughout 2024.
Yeah, well, in fact, Matt, it's a good point, because often occupancy increasing, the reason for it may be rent declines. And wouldn't that make sense? When there's been a philosophy, especially in 2023, from apartment operators, saying, we need to get heads in beds. No one likes giving up a lot of loss to lease and leasing an apartment for much less than you were budgeting leasing. But if you have, dozens, if you have 10+% of your apartments that are sitting vacant, they're not producing any revenue. And so you get to a point of where let's just get people in these units paying something to generate some revenue, because I'd rather get, I'm asking $2,000 a month. Maybe it must be a really nice place. But if you're getting nothing, maybe you'd rather get $1,500. That's pretty close. Now, that's not going to look great in your spreadsheet, because you thought you're going to get $2,000 and you're going to get $2,100 in the next couple of years. So you have to go back so far. But again, you got 10 leases, 10 units that are vacant. I'd rather get those filled up and get $15,000 a month.
Yeah, if you
miss out on the 5, then 0, 50. I mean, what's bigger? It's a bigger number.
For sure. I agree. Yeah, if it's empty for 6 months of the year, then it doesn't really matter.
And that's been going on in the Sun Belt quite a bit. So you could see how that would be increasing occupancy. But we're not. It's not as though we're seeing nearly as much negative rent growth nationally. We're still seeing some in the Sun Belt, but rent growth actually isn't doing nearly as bad as it was last year. Also, I think that did we report last week that we hit a positive month in March or April?
I'm not sure that Apartment List is positive, but the two reports here from RealPage and Yardi Matrix are both positive.
Yes, that's what.
And
of course,
and it is also worth mentioning that these trends are very slow, especially for occupancy. It's not going to change too drastically ever. And the fact that it has changed even slightly, I think, is worth noting, especially because it's positive.
I see Alexandria Ocasio-Cortez. I
think that's her.
It's not. It's not the New York congressman. Okay, sorry, Matt. Anyway, apartment occupancy ticks up for the first time since early 2022. I thought this was going to be something about rent control.
Understood.
I'm joking. Okay, so we're talking about occupancy ticks up for the first time since early 22. Maybe that's one of those comments, Matt, that we got from a listener a couple weeks ago saying that he this is where we're getting the negative comments. Basically, guys, stick to the data. Quit making jokes.
We got.
And I said, you come for the economic data, and you find yourself staying for maybe some humor and some jokes. And we're doing an hour-long plus show, and so a little bit of humor. I couldn't listen anyway. So let's go back to this AOC article. Matt, bring us in.
RealPage has recorded occupancy increasing from 94.1% in March to 94.2% in April. Not a big change, but worthy of mention because it's the first time since February of 2022, more than 2 years ago, that occupancy actually increased on a monthly basis. Now, it's worth also noting that these occupancy trends essentially operate within like a 3% band of possibility. For CoStar, it hasn't been much higher than 95%. It hasn't been much lower than 92. For Apartment List, it's between like 96 and 93. And for RealPage, it's like I looked in the past, and at the upper end is 97.6, and the lower end is 95. 94.2. So within that smaller range of values, you can look at this 0.1% increase as more like a 3% change, which is still pretty good. Still relatively little, but a meaningful change. Those 10 basis points, when you're only looking at, a total of 30 that you can operate within that range, that's pretty good.
Yeah, well, I mean, flat's better than a decline.
Yeah, exactly. And it is not a decline. It is like we have dipped down and we have had this plateau of lowness, and now we're steadily gonna hopefully rise back up.
Yeah,
that's the idea, at least.
Let's look at the rest of what this report gets into, Matt. I know a little bit on rent growth, looking at some future supply, looking at the Q1 2024 annual supply. Like we got 479,000 units, and then demand. We were at 317,241 units.
About 150,000 unit difference, and that's supply outpacing demand.
So, I mean, to me, that's negative absorption, which kind of does not line up with some of the other data that we've seen. Yeah,
I'm not sure how that balances. I think that I don't know exactly how they record that or what counts as negative absorption, what they're comparing to. But I did have a little bit of some context for the occupancy numbers, and like I mentioned before, CoStar had its occupancy at its highest in Q3 2021, and it's gone down from there. But they're actually projecting an improvement in total occupancy next quarter. What is interesting, and I don't have the tab up here, but actually CoStar, when it comes to stabilized occupancy, so I think that they're talking about that you're taking the new ones, the newly built apartments out of. Okay.
Yep.
So when it comes to stabilized occupancy, those numbers aren't expected to come down until Q1 of 2027. So this supply wave may be cresting in the next few months, but we will still see elevated numbers of newly built apartments for the next year or so, and they still may trickle down and affect stabilized apartments for years to come. Yeah. It's just an interesting way. And by the time the peak of this stabilized occupancy, we could still be having rent growth at that time just because of the way the market works and the lags between all of these periods. I just thought it was interesting to focus on that. Now, focusing too much, I think, on the enormity of apartment supply does pull attention away from what's happening right now. I think that we have been seeing higher than normal absorption rates, maybe not balanced against the supply, but the absorption rates are a little bit elevated if you talk about pre-pandemic averages. And I'm clarifying here because in a way you can interpret occupancy numbers as a sign of how the apartment market as a whole absorbs new units. Now, just so I'm not messing with language here and I'm getting the right terms here, absorption is the percentage of newly built apartments that are filled, or the number of newly built apartments that are filled with renters.
Well, it doesn't have to be newly built, just apartments in general.
Oh, really? So if it was empty last month and it's filled this month, that's absorption?
Mm-hmm. Yeah,
okay.
Units absorbed. Yeah, because if no one builds a new apartment, if there's vacant units, someone moves into those that were previously vacant those units were then absorbed.
Okay. All right. Well, that's I'm clarifying there too. Yeah, because occupancy shows how the apartment market's absorbing units, but when you're talking about absorption, a lot of times you only just get that raw number, so it's harder. It's harder to see it in relation to
exactly. Things. You have to have the context.
And like you mentioned too, you get a fuller snapshot than just occupancy, showing that positive 0.2% monthly rent growth. It also some regional market-based numbers showing the Midwest on top for rent growth with 2.7, Northeast with the top occupancy number, followed by the Midwest. And then the West is a clear notch below for rent growth and occupancy. It actually does look like the West is doing a little bit better than the South, which is clearly at the bottom. And the West is this kind of middling third place with occupancy only slightly lower than the Midwest. So regionally, it did seem like, despite the differences with year over year, and this is the same point emerged that we found in the apartment list report, there's a lot more even performance when it comes to month over month. We're reaching kind of an equilibrium for the market.
Yeah, got it. Anything else on this real page report, Matt, before we pop on over? Do you want to get
Not exactly. No, I mean, they show the rent growth leader nothing has dramatically changed. It's still a story of the Midwest and Northeast. And again, a little bit of change is happening on the month-to-month level. It does look like the South is catching back up.
Yeah, not surprising. Just for our radio and podcast listeners, apartment rent growth leaders, April 2024, the number one spot is Milwaukee, followed by Cleveland, followed by, tied for third place, Kansas City and Washington, D.C., and Virginia Beach, all tied for third. And then in sixth place, two Ohio rivals, Columbus and Cincinnati, followed by Chicago, then Newark, and then tied for 10th is Indianapolis, Boston, and Anaheim, California. So yeah, interesting mix. Again, a lot of Midwest, 1, 2, 3, 4, 5, 6, 7 out of the 10, even though there's more than 10 listed on this list. Well, I guess that they eliminated 5 and 7, I guess, to make volatilize.
Yeah.
So Midwest still dominant in terms of performing in the apartment market. I know Sunbelt investors are excited to get in, maybe at some low basis.
The Virginia Beach.
The Virginia Beach is in there. Now, Virginia Beach, I think maybe, again, someone please correct me, has had dynamics more similar to a Midwestern market over the years than the Sunbelt. I'll quantify that at a later time, but this doesn't really surprise me nearly as much.
Interesting.
But Virginia Beach has been a relatively strong market for the last couple of years.
Yeah.
Not an expert in it though, so I don't want to jump all around and speaking out of turn. Let's look at the laggards just real quick, and then we can move on because we talk about this stuff all the time. That's why we're here. Wow, at the bottom of the list, Austin, Texas. No surprise there, Matt.
Yeah.
Rents are way down 7.4% month over month.
No, that's
year
just,
over year.
Yeah, it's
annual effective rent. Oh, I got worried. They have that unchanged month over month number.
Yeah.
It's unchanged month over month. It's a month over month. 7.4% down. Just annual effective rent change. That's still a lot, and that's compounding off a year of negative growth back in 2023, Matt. Then Jacksonville, Florida, San Antonio, Atlanta, Orlando, Raleigh, Durham, Phoenix, Charlotte, Tampa, Dallas, Nashville. Matt, this is a list of some of the darlings in multifamily. These are the markets where so many syndicators, so many institutional equity were dumping money in just a couple of years ago, and they seem to be the worst performing markets.
Yeah. Supply.
Wow.
And, none of those markets are suffering from population losses. It's purely supply.
No, and most of these markets will absorb all of these units over time, and that there's probably some good buying opportunities. But just as you were mentioning earlier, Matt, this supply is not going away next year. This is going to be pressure over the next several years.
Yeah.
And you're going to have some seriously patient capital to get through the next couple of years if you're thinking about investing in the Sun Belt. It's not the same Sun Belt that you invested in back in 2018 or 2017 or whenever, pre-pandemic. It's a different environment. And, people are going to reinvest in the Sun Belt. Again, there's great markets. I think the Midwest is still a real sweet spot, seeing really good growth from a population standpoint, jobs. That's got all the regulatory and tax environment that the Sun Belt has, but no hurricanes, so you don't have the insurance pressure. It's just as affordable, if not more affordable, than most of the Sun Belt. And again, talking about inefficient markets, taking advantage, getting great opportunities and great deals. The capital that's out in New York City or in LA or wherever, they're just not as tied into the Midwest. And so they ended up not making as many investments there, but there's still ample liquidity. So again, savvy investors, that's where they've been going to get yield, but also growth. That's what we've been doing. And I think that we've been saying this for a long time, Matt, and now there's just so much data I think it's important to highlight. Yeah.
And it's interesting too, even as the Midwest specifically has had, it's been a rent growth leaders for about a year, or maybe more, and did very well during the pandemic. Yeah, sure. Tampa was posting 20%, but maybe Indianapolis or so
was doing like 15, 14, 15,
whatever. Yeah. So,
but then Tampa's gone negative for the last year and a half while Indy keeps growing.
And I think
tortoise in the hare situation.
I wonder, there's not infinity builders in the world. all their attention turned to the Sun Belt, and they were building when rent growth was high. They were so excited, and financing was super easy. So they were able to build 8 apartment buildings where before maybe they could have built 4 or 5 or whatever. And now when it's looking like Midwest is looking great and it's attractive, maybe it could attract builders, but they don't have the interest rates that they couldn't if they wanted to.
So there's some legs.
We've hit a little bit of a swing, just of the way of this wave of supplies regionally has been felt. We're not going to get the overreaction of super supply, even though we're the rent growth leader in the Midwest.
And the jobs coming into the Midwest, Matt, have been incredible. Again, I can't go like a week without some big announcement. I mean, the last deal that we were working on, we closed a couple weeks ago down in Evansville, Indiana. I was telling our investors,
keep getting headlines.
Well, I kept saying, I don't have a headline because Evansville is a strong manufacturing market, and I literally told them, I don't have like a article of that, things have opened in the past. So I don't have something that's like new that's opening up right away, other than there's good momentum. I go, but it would not surprise me that in the next week, month, year, I don't know. I didn't know of anything. There's going to be a big announcement. Less than 2 weeks. It was like a week after we closed on River Club down in Evansville. But Toyota made that new announcement. They're going to make a $1.5 to $2 billion new investment into their massive
big
facility.
Expansion for a market like
expansion.
Evansville.
And we have a lot of residents that we know are working here, so it's like it's perfect. And then and that's specifically for like EV. I think manufacturing Toyota's some EV line, I believe. I'm not sure exactly what it is, the Prius or what.
You got that big data center coming in northern Indiana, around in South Bend. I mean, we just covered a few weeks ago a CBR article talking about all of the chip plants going in Ohio and this bioscience plant going here. A lot of manufacturing is coming into the Midwest, although we don't have a saltwater beach in the Midwest.
No, but there is a great river that we've got.
There's a great river. We have water. A lot of properties have great water access.
But talk on natural resources. I mean, we do have land that we can build, and we also have a lot of groundwater. Like we don't water in Indiana isn't an issue. I mean, there's been debates about project in the Leap District and Boone County and getting water from the Wabash Aquifer and all that, but we have a ton of water. We have a ton of groundwater. Which is not an issue. We don't have major natural disasters. I mean, occasionally we get a tornado, but tornado has not affected my life personally. Ever. Well,
Madrid earthquake zone notwithstanding, we haven't had a big old earthquake in Indianapolis specifically, but.
We're sleeping pretty well at night. Anyway, I don't know. Life's good in the Midwest. So let's move on, Matt. You want to move to this Reuters? Let's go to the consumer side.
Okay. We can skip the Yardi Matrix.
We're going to skip the Yardi Matrix. No. Let's skip it.
It did support, and I'll just. I'll review it like super quick. It just supports the same kind of absorption and occupancy story as was given. It also shows it showed pretty decent positive rent growth. What is it? Year-over-year rent growth at 0.7%, month-over-month at 0.3% for the nation, and that compared with RealPage's 0.1% year-over-year and 0.2% month-over-month rent growth. And as a bonus, I'm going to give you the CoStar numbers, which have year-over-year rent growth at 0.9% and month-over-month at 0.35%. The reason why that one was so specific is because I had to go into CoStar and calculate the month-over-month rent, because CoStar does not give its paying customers monthly rent growth data for the nation of the United States. They only give quarterly rent growth data, and I don't like that. Maybe
it's not a cheap subscription either. But you've met.
They have the data. They just don't calculate.
They've got the data. But you in the past, haven't you reached out? And they've been able to provide it, or no?
No, I've reached out to nothing. So
can we get someone from CoStar to come on the show? Talk about that?
I've also reached out and I will continue to.
Okay.
I think this is a persistence issue for sure.
Okay. Well. Yeah, we need some monthly data.
Sure.
Come on, everyone else is providing it. Supposed to be leaders in data.
Well, and what started me off on this mission was seeing a Wall Street Journal article where they had monthly CoStar data. So they're giving it to some people and they're not giving it to me, which makes me very jealous. We are
if Wall Street Journal's using the right information, or they're attributing their sources correctly.
Well, we're a quality media source, just like the Wall Street Journal is what I'm trying to say.
I've heard that.
They follow us, I'm sure.
I think they do.
Yeah.
I think they do. Okay, let's move on to the consumer, Matt.
All right. Yeah.
What's going on with the consumer?
This Reuters report showed weaker jobs data, and this was after last month showed stronger than expected jobs data. This is one data point among many that we'll cover here in a couple minutes that suggests that we could be approaching an inflection point for inflation. Job gains were a little low, and wage growth, while still elevated above historical norms of around 3.5%, is down slightly. So wage growth moved from 4.1% to 3.9%, and unemployment is up from 3.8 to 3.9. Small movements, but still things are not moving towards overheating. They're moving in the other direction. These are two big things that the Fed watches: wage growth and jobs. Their mandates are, jobs and inflation, and I'm sure that they're looking at this maybe with a sigh of relief. Maybe they're thinking something different. Although it's not dramatic enough to convince him to do anything.
True, but I think that it follows the Fed's narrative that things are slowing down. Inflation is cooling. We've had a couple bumps in the road, but generally we think we're we're on this glide path down to whatever type of landing that we're going to call it. And you brought it up. You mentioned the right point, Matt, is the balance between this dual mandate of stable prices and maximizing employment, stable employment, and they have to weigh what is the bigger risk to how they're going to lean in on their policy decisions. Yeah. And the labor market has been so hot that it's not even a question of does the Fed need to step in and support the labor market. Okay, so that's not the labor market's not a concern. The other mandate, stable prices, aka inflation, that is the concern. So, they're not going to come off of higher interest rates, which the goal is to reduce inflation by weakening the labor market. They're not going to reduce those rates, when they're seeing that the labor market is performing really well. There's no reason to. They have to see some signs that there's some labor market deterioration and that inflation is moving generally in the right direction so they can shift their balance of risks and focus. Yeah. And so this is opening up the door to, I think, start having those conversations of, okay, maybe we ease off on focusing on stable prices and we need to make sure that we're balancing to make sure that we don't kill the labor market over time.
Yeah. Even if their sole mandate was inflation, without respect to jobs, if they were looking for signs that it was lowering, that they were doing a good job rather than threatening to do a bad job, with recession. Yeah. If they were just looking at the jobs, they were all or inflation. I'm sorry, jobs is one thing. Jobs a little cooler than possible, and then there's a couple other things that that we can talk about here in a second. But credit, it's also kind of cooling in a way, and savings also. People are depleting their savings as well. Yeah. So if you're looking for reasons why people are going to see an expensive value meal at McDonald's and say, no, I'm not gonna buy it today. It's too expensive. Yeah. Those things, your job doesn't pay, or you don't have the job, or there are less jobs out there. There's less credit out there, or people are taking out less credit. There's all these signs that maybe people are deciding or have the conditions that will enable them to say no to more expensive things. Yeah. These are just ingredients, and this next week's CPI report could tell me something different. But I think that this would still be valid even if there was a little bump up. I still would think, given this evidence that we're seeing in just the past week, things could cool down in the future, in the months to come.
Yeah. And I think very quickly we could see the shift from a concern over cooling. In so many areas of the economy are still going strong. But I mean, recession or manufacturing has cooled off a little bit recently. Again, wage growth. While wage growth is still outpacing inflation, but it is moderating as inflation is moderating. And again, the concern was this wage price spiral. If wages kept being increased, and then prices have to be increased, and then it's a chicken and the egg between the two. Yeah. So we're seeing less evidence that we're getting in that type of scenario. Yeah. And so then again, the base case hasn't really changed, at least for me. Is I see evidence for elevated growth rates, like maybe a little bit above 2%, or maybe, I don't know, since we've been below 2% the last decade, maybe we're at 2% or a little bit above.
For,
I think it's going to be elevated for inflation.
For inflation.
Yeah, but I don't see the driver and the narrative that would contribute to the the runaway, the hyper,
like a feedback loop.
Or like when I hear someone today say, interest rates could go much higher. It's like you do have to be prepared for that. That's a smart thing to be aware of. But I just don't see it. I don't see the path. I mean, a lot of suggestions that we can make. Just was like I see a path to near zero rates. Like I can paint you that path.
Yeah. And these are not new movements too. I think the path is, this graph just shows here, average earnings were up 5.9% year over year in March of 2022. That was kind of the peak. And then they've gone down all the way now to 3.9%. Now, if you're looking at for kind of like a pre-pandemic average, it does look like 3.5% is like the generous.
And this is rate of growth.
Yes, this is average rate of growth.
I'm just clarifying. So we're still growing, at above, just below a 4%, rate of change.
Wages, that's a pretty good wage bump.
And if inflation's really just above, 2% right now if you strip, the housing out of CPI. I mean, that's wages are almost double inflation.
And that's the other set of numbers that I didn't include here is rents. There was a bunch of articles that were like rents haven't even been really reflected in inflation, and we should be ready for this deflationary effect of lower rents.
What do you think is going to happen when that happens, Matt? And when like a CPI print that ever comes in that says rents have just fallen off, it'll be in the same period where rents actually are increasing. I'm sure.
For sure, almost positive.
And so then what are our reaction?
Well,
I'm just anticipating our reaction of just bang our head against the wall because that's what we see these CPI prints come out and the market's reaction of we're in this hyperinflationary environment because of rents, and we're looking at all of the data and just direct experience being like, no, rents and almost everywhere in the country. I know. Yeah. I don't. Yeah.
Don't make us look bad.
Well, technically, if you actually break down the components of CPI, 36% that makes up shelter. Yeah. It's not the greatest dinner party conversation. Even now that I'm thinking about it, I definitely have been that dinner party guest that's talking about CPI.
Oh, for sure. Every weekend for me.
Like, well,
CoStar researcher, I'm going to get on the show. We'll get a CPI person from the Bureau of Labor Statistics.
Are they picking up the phone?
Well, I am a Facebook friend with him, or not Facebook, LinkedIn connection.
Bureau?
LinkedIn connection
with the whole bureau, or just with a guy?
It's close. It's one guy, but
that's all you need is one.
Yeah.
He's gonna be your in.
Yeah, he's my in.
You can have a mole.
I'm not gonna abuse my LinkedIn connection, but I will send him a couple messages.
Yeah, there's no insider trading, right?
No way.
This is just got a guy at the BLS. You know that. So viewers, the market can know.
And what is he going to tell me that we don't already know?
Well, just unnamed sources. Unnamed sources at the BLS. Just keep them unnamed.
Yeah. All right. Got it.
Okay. No, who was I was talking to their fiance or husband was working at the Federal Reserve in St. Louis, and I was like, I'm like, oh, so can we get some details?
Yeah.
And they were like, he doesn't know anything. I'm like, no. I'm like, well, it doesn't seem like anybody knows anything anywhere.
Can you turn the dial down? I'm sure it's somewhere in the building.
Can he make a suggestion about how to calculate the CPI?
Raise his hand during a meeting.
Yeah, they know. And they're like, we know. We're not.
My friend's fiance told me this. Oh, that's funny.
Yeah. All right, but so consumer credit oozes up 0.4%. Matt, is that anything to worry about, or it doesn't seem that?
No, I think it's a little bit of a misleading headline, a little bit of a bury the lead kind of situation. What's really noteworthy is that this consumer credit grew much more slowly than expected. The quote here that they really should have put in the headline is, after bumping up a revised $8.4 billion in March, analysts had expected a larger $14 billion April increase, but the actual number was $11.1 billion, which again is less than expected. So consumer credit is actually slowing. And there are, we can look at the different charts that show this, whether it's revolving credit or all consumer credit or all private credit. There's a bunch of these figures that, because I was a little unsure. There's a lot of different terminologies when it comes to these credit measurements. But what I did notice is if you're measuring it based on year over year change, all of these measures of credit show a consistent decrease from around like third quarter 2022 till now. And again, even in this article alone, if you're not even looking at kind of the longer trends, that's like a 20 to 25% below the line.
Yeah.
So it's not only less than imagined, but it's significantly less than imagined. And I think we were talking about this before. A lot of people talk about credit as it's never been higher before, but like credit's always increasing. Unfortunately, it's always increasing. It's always going to be higher than it's ever been before. That is just like the population. Tomorrow I'll have a headline there that says, there's more people around, of course. There's
Well, the national debt, which is a problem, but yeah, exactly.
And notwithstanding like the headline about oozing up, it does that Motley Fool article does give a nice breakdown of what these different terms mean. Not like a perfect one, but it does talk about how revolving credit is like credit cards, and that has remained erratic with minimal 1% annual gains. At the same time, non-revolving credit, which is fixed installments like car payments, has carried credit increases with a 6.4% annual gain. For April, revolving credit fell an annual $10.9 billion. So that means a quick reaction, right?
Yeah.
I'm not taking credit cards, compared with a $111.3 billion positive flow for non-revolving credit. So these big purchases people are still making, or they have to make. I mean, sometimes you got to have a car, you got to have a house. But maybe the shorter term, am I going to get that $10 value meal at McDonald's? No, it's too expensive. I'm not going to use a credit card.
It's interesting.
That's my anecdotal explanation.
Because, and this is different from, I think, some of the data that, we've seen maybe last year and that gets talked about a lot. That's, showing, like, as you mentioned, just, there's a record of consumer debt out there right now, and the consumer, is loaded up with credit card payments. So it sounds like your argument to that, but I think a lot of people might say, yeah, I've seen the article, and consumers are, they're squeezed right now, they're up to their eyeballs in debt. And you're saying is like, the consumers have, some debt, right? Quite a bit of debt.
Yeah.
But they're adding to that debt at a much slower pace.
Correct. Yeah.
And that's a good thing. We're trending in the right direction.
Yeah. Yeah.
And so we don't necessarily just need to look at the aggregate total amount that everyone has already owed, because again, a lot of, it's debt sometimes gets, removed and destroyed, but a lot of times it gets rolled over. It doesn't always get paid off. It kind of, a lot of times you roll it. You maybe pay off your credit card, but you're going to put some more money on your credit card. So you're paying it off, you're putting it back on, but you're putting a little bit less on it.
And think about it this way. If revolving credit only went up 1%, whereas inflation went up, 3.8 or 3.5%,
that's true.
Then you are getting kind of a positive effect. So that's great. It's great that people aren't getting into debt as steeply, although it's not erasing it, but it's still it's good to see that.
Again, this is the revolving consumer credit owned and securitized. I mean, we certainly were at this really high peak of growing 15% year over year back in, I think it's 2023, Matt, and I think that's when a lot of these articles really started coming out. It's January 2023. But we are, coming down off of this, which is a really good sign.
Yeah.
Maybe this is, inflation reducing. It kind of lines up with that period. Seeing inflation starting to really kind of take a back seat. But we still are at elevated levels of growth, Matt. Again, on credit card, percent change from a year ago, we've grown 7.8%. I mean, we really do have to go back almost to before the great financial crisis, until we've been at a similar spot, other than, as post COVID, obviously we went from, we shot down, everyone got their stimmies, and paid off their credit card or stopped using their credit card for whatever reason. And then it shot back up, which is all just, again, fascinating to have lived through.
Yeah. Well, and if you want to talk about that is a really great segue to this article from the Federal Reserve Bank of San Francisco. What happened during the pandemic? Where's all that money?
Where did it go, Matt?
There it is. Well, I don't know where it went. I know that it went. That's the headline there. Pandemic savings are gone. What's next for U.S. consumers? In August,
The government helicoptered money and...
Well,
Made it
We make sure to
disappear.
spend it.
Where'd all the money go?
I'm good at
Look how that happened. How I mean, again,
Strange.
it's like the sugar rush. It's like
Yeah.
candy, good, and then
And-
I am still hungry. There was no nutrients.
And I'm hoping, and just like this article from, and this is kind of a informal blog post from the Federal Reserve Bank of San Francisco, but I mean, it's pretty formal. It's from the Fed.
As formal as the Fed gets.
Yeah, exactly. Well, but hopefully we will be getting more information on how much of the effect, how much did stimulus affect inflation? What was the real cause? Because it's a little bit up in the air, but as we get more in distance, now we can kind of see, for example, in this study, it shows that in August 2021, pandemic total excess savings was peaking at $2.1 trillion. And now March 2024, total excess savings is a negative $72 billion. Now, they define this as pandemic era excess savings, but that's the time period.
So what is that cumulative pandemic era excess savings?
Well, they define it right here. No, excess savings is calculated as the accumulated difference in actual de-annualized personalized savings and the trend implied by data for the 48 months leading up to the first month of the 2020 recession as defined by the National Bureau of Economic Research. The stimmies, maybe? I mean, that was very, I felt like I was reading fine print there for a second. But my guess, it is the savings that accrued during the pandemic, and it is, well, now it's gone. I think that the most useful and
Wait, it's more than gone. It's we've now gone into debt.
Yeah,
by $72 billion.
And we're drawing on something that's not pandemic era savings, that's for sure.
And is this not, I guess, a little counter to, I guess, the data we were just looking at? The consumer credit is reducing.
You would think that. So what is, if
or yes,
if
we're
savings are
looking
gone,
at savings, we're not looking at debt. But I'm just saying that if it's gone negative,
wouldn't you think savings is gone, credits less? Or people are using a credit card less, people's savings are less. Wouldn't that mean that the only possibility is in the spending less? But again, I'm sure I'm missing something big. I would know.
And not necessarily, I think they're spending more on essential things and, less elsewhere. And, again, it's the rent, food, utilities, gas in the car.
Yeah. And if you look down the second chart here does talk about, so how much of a monthly change was it? So it was positive until maybe around that August of 2021, and then after that we started eating into our savings. So September we started eating, September 2021 all the way until March of 2024, which, and this is a little bit more worrying, is that we seem to be increasing the amount where we're eating into savings, far less than it was, or I'm sorry, a little bit more than it was in 2023. So I don't that's a little bit of I can't square that circle as easily as saying, well, no, they're spending less. Well, no, they're kind of eating into savings, and there's a little bit of speculation on maybe the implications and what this might lead to from the Federal Reserve, although none of them are, they're just as satisfying as my, well, maybe they're spending less.
I wish there were more reports, Matt. I don't know if you can find some that really break this down relative to different kind of income demographics.
Yeah, that's
different
a good point.
different quartiles of income, or however the breakdown is. Because I'm assuming there's, and because I'm saying this, seeing in our view of consumers from a property manager's perspective, and owning and managing properties that are both would classify as kind of workforce housing, a little bit more blue collar, rents in the $800 to $1,000 range, and then we've got apartments that are really more A-class lifestyle that rents are in the $1,200 to $2,000-ish range.
Yeah,
we've seen different behavior in terms of collections and just demand and occupancy and some different behavior, and just looking at how that's breaking down and who, because the wages are growing in the bottom quartile a little bit more than elsewhere, but inflation, that population is also much more sensitive to rising prices and inflationary pressures. So it's a I think that these broad studies, which are good for general information on the economy, making these macro decisions, but to me, it begs more questions of, some of the details and the nuances.
Well, and you can see, the credit and savings seem to, in some ways, contradict each other a little bit when you're throwing all these ingredients in. Sure, I grouped them all because they say cooling to me, but I'm sure I'm missing some things.
And then there's also a data and noise conversation also of what is actual information that's going to tell us something that's a real trend on things are going, and what is just noisy from other influences. Whether that is like the stimulus aren't really noise, the stimulus checks. They were more of like a signal, but like really kind of short term and not trend oriented.
Yeah.
So
but that's what I did.
Interest rates, added a lot of noise. And confusion.
Yeah. But that's what I did think was kind of compelling, at least, about the numbers that we got on jobs, whether it's unemployment or wage growth, and the stuff on credit that we were looking through is, well, these are long, multi-year. It's not like things are jumping up and down and really inconsequential or just hard to read. Yeah. We're seeing this trend, so it means something, and it definitely doesn't mean things are heating up. That's what I was talking to you before. I was like, well, I don't want to go outright and say that CPI is going to be weaker. I'm just saying, like, well, given this evidence, it's far more likely that these are cooling effects than ones that would heat up the economy.
Yeah.
Leave something in the comments. Show me where I'm missing so that I can prove future episodes and we can really track this. But it does. Yeah, I'm not seeing where inflation is going to even come from. Even energy prices aren't quite so bad. I think obviously geopolitical stuff is like the only thing that I can kind of see as this black swan. They'll fly by sometime.
But I do think consumer psychology has changed, because now the consumer is like back in the mode of being like, no, rates are going to be. I don't know if businesses all are, but some are. Some certainly will be. Mm-hmm. But I think more and more consumers are saying, hey, interest rates are going to be this high, and they could be this high. It could be higher. I think they're saying like, well, look, never thought it would be like this. How bad? I mean, just think of the last 4 years. We had between pandemic and lockdowns and turmoil of all different kinds. I think people are prepared. Nothing phases us anymore. It's like, sure, 10% interest rates, whatever.
Well, there's a general feeling of dissatisfaction in the economy, and it's almost it seems like people are paying a lot more attention to inflation than they are to interest rates. The complaints are always they lead, and whether it's news reporters or men on the street or women on the street, they're talking about inflation. They're not like, oh, interest rates, that's crazy. No, they're talking about gas prices or egg prices.
I think you're right. I think people are talking about interest rates too, but I think that enough people interact with.
That's a good point.
Rates.
I did see they talked to panelists and stuff, and that did come up.
Even if it's and again, this will be like not true, and people will continue to believe it. But people, are using high interest rates as a very legitimate excuse in most cases of like, I'm never going to be able to buy a home.
Yeah.
Like I am never going to be able to buy a home. Look at interest rate. I couldn't buy a home in 2020 when interest rates were 2.5%. Yeah. How am I going to buy a home when interest rates are 7%?
Well, and talking to Jay before, I was like, it's kind of frustrating living through. Now I was just beginning my kind of professional life or whatever. I graduated in 2008 and during the Great Financial Crisis, and I thinking about how dismal it looked then, and how dismal it kind of was then. Yeah. But consumer sentiment's just about the same as today. Today doesn't seem quite as dismal, but it seems like maybe it's inflation. What Jay said was, before it was like, well, you don't have a job, and like if you just get the job, then maybe you'll have an opinion on the economy. But now it's like, well, I got my job, I'm doing everything I could, and I still can't pay for everything because of inflation. Yeah. It's a little bit disappointing. Part of me thinks, in this kind of like, it's a little bit more emotional. Whereas like if right now we're almost set, and we can almost reach there, and we're almost at a good point in the economy, and we're so close, and you feel it more keenly than before. You were so, you're like, oh yeah, I'd love to have a job, that'd be great, and it's. You've got a lot more to hope for maybe if you were lower on the total, and that's it's. I think it's a weird psychological thing where
definitely a different environment. I mean, the job.
I don't understand it.
Yeah, well, because again, we when we were entering the workforce, there were like no jobs to have.
Yeah.
And any of the jobs were, again, we were talking about some new positions, hiring people on, and like not like super high level positions. And some of the salary ranges, I'm like, 60,000 for what? I'm like, I remember. I'm like, I thought that was like a $35,000-$40,000 a year, position. I mean, I remember getting out of school. I remember, 2000 when I moved back to Indianapolis, I guess, it was a more relative context. I remember me and my friends being like, if you can make 25, 35K a year in Indy, you're like,
you can live on
you
it.
can live just fine. And honestly, like 25, you can live like totally fine. Like little
live.
You can live.
Yeah.
Yeah, you can live.
Yeah.
But like 35, 40, like you can have like a decent, like as a single person, young person.
Got roommates or whatever.
You got a
you're able to-
roommate.
yeah.
You can figure it out and like totally have a good experience in like living here.
Yeah.
I mean, like that's how much money I made for a long time.
Yeah,
Like
yeah.
35K a year, I was like, all right, I'm not doing great, but I'm getting by.
Yeah, yeah.
And so that's not like a number that's an option.
Not anymore. No. Whether it's housing costs or.
Yeah, or at least, I don't know, for the
Yeah.
jobs we're looking for.
Yeah.
So it's just a different environment.
Yeah, for sure.
And then it's like, well, and then you talk to these kids that are getting out of college, and they're like, yeah, and they're like shooting for, close to six figures in the first couple of years.
Yeah.
And I just remember when you're a little bit older than me, graduated a little bit, a couple years earlier, but I remember like hearing a buddy who was getting ready to get a job at Procter & Gamble, I think, and was going to be making like 55 a year.
That's solid.
And we were like, this dude's going to be loaded.
Yeah, yeah, yeah.
Like what? How do you, it was just like incredible.
Yeah.
And he ended up not getting the job because they gave him it's so funny because the guy, it was not they gave him he failed his drug test and had like not participated in not been partying for like months, but it's Procter & Gamble, so they make the hair tests.
Oh, yeah.
And, he's in college. And so, at one point in like 5 months ago, he partook, on 420 or something. Or whatever, went to an Alicia Keys concert, and someone passed him a clove cigarette, and then 5 months later he gets, and so they didn't hire him anyway.
Well, that's the job environment then.
Yeah, that's the difference.
It was a job. It was an employer's market, and now there's a lot. Yeah, for sure. Yeah. They could demand it. Now they probably can't do that because they get no hires.
Yeah, exactly. Out of college now he went off to do much better, greater things. Yeah. But it's fascinating. Well, great episode of the Gray Report. Okay. Make sure you're signed up for the newsletter. I mean, that was the impetus for the whole Gray Report, the show. It's because of the award-winning newsletter. Yep. The Gray Report you can find at graycapitalllc.com/newsletter. Subscribe to the Gray Capital YouTube channel. Click the bell icon. That's going to give you an alert every time there's a new episode that is dropped from the Gray Report or any of our insights. When we get a new deal, you're going to get a little ting that says you got a deal. But on that note, if you are a accredited investor, hop on over to graycapitalllc.com and request access to our investor portal. That way you will be the absolute first group of folks that get access to our new exclusive multifamily offerings. And you have to be an accredited investor. Unfortunately, that's just what the SEC says. You have to be accredited, but this is an exciting opportunity. I could spend the next 2 hours just ranting and raving about this new deal that we have that we're incredibly excited about. It's in Indianapolis. It's A-class, waterfront property. I got to shut up there. Stick around. Make sure you like and subscribe, and we'll catch you on the next Gray Report.